So if gold goes up sharply, and there is a reason to think it will, if gold goes up sharply, there will be sellers of gold and piling into silver, but that will have a much more leveraged effect on the silver price than it does on the gold price. Because if you take $1 trillion out of gold, it hardly moves the market. But if you put $1 trillion into silver, it pushes you've got this hugely leveraged effect because silver's only a $2 trillion market.
People were talking about $40 silver, $50 silver. I'm still bullish, and I'm still continuing to try to stack silver as much as possible, as well as gold, of course.
In the first half of July alone, silver prices have jumped over 5%, reaching a near-term high of $39. That's a 34.87% gain since its breakout at $28.92 earlier this year. What we're seeing isn't random volatility, it's the market catching up to fundamentals that have been flashing red for months. Clive Thompson, a veteran market analyst, says it best. Charts don't predict the future, but pair them with hard data, and they'll show you where the pressure's building. In this case, silver's climb makes perfect sense. Industrial demand, especially from the electronics sector, is outpacing mine supply. That's not speculation, that's straight from the Silver Institute, and the gap is growing. To bridge it, the market is relying more and more on recycled silver. Prices are rising not because of hype, but because they need to. Recycling isn't optional, it's essential to meet demand. Currently, electronics account for approximately 33.9% of total silver usage. That's already the most significant slice of the pie, and it's about to get even bigger. Think artificial intelligence infrastructure, electric vehicles, clean energy tech. All of it runs on silver-heavy components, and none of it is slowing down. Since 2016, demand from electrical and electronic applications has jumped 51%. That trend isn't reversing, and neither is the supply problem. Silver has been in a structural deficit since 2021. Add it all up, and the cumulative shortfall by the end of 2025 is expected to hit nearly 800 million ounces. That's not a rounding error. That's a system under strain. So, when you see prices climbing, don't think of it as a short-term rally. Think structural repricing. If prices were falling while demand kept rising, you'd have to assume one of two things. Either the data is flawed, or the market's being rigged. But that's not what's happening. This time, the chart and the fundamentals agree, and that's when you pay attention. We may get short-term pullbacks, sure, but the setup is straightforward. Tight supply, rising demand, and a price chart that reflects both. If you're watching silver, the movie so far isn't the end, it's the beginning. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I don't think that charts on their own, without external information, tell you the future. But when you have external information, then you can interpret it in a way which will tell you the future. And so what I see here is a rising silver price. Okay, that's useful. I mean, okay, it's come off for the last week or so. That's neither here nor there. And at the same time, we know that the demand for silver exceeds the mined supply, the demand coming from electronics industry and other industrial usages. So that, according to all the estimates, and my primary source for this is the Silver Institute, the gap between mine supply and industrial use is going to grow bigger. It's been growing. We've been in a deficit of silver for the last few years, and that explains why the silver price has been rising. It has to rise to suck out recycled silver into the marketplace because there isn't enough silver coming out of the mines. And that gap is going to get wider in the future. So logically, silver should continue to rise to suck out that recycled silver. So do we get confirmation by looking that that's actually happening? When you look at that chart, it's telling us that the direction of travel is upwards, and that makes sense with the information we've got. If it was going in the other direction, I'd say, maybe somebody's lying to us. How could this price be going down when allegedly the demand's going up? But obviously we're told, and we have to believe this, that the demand is going up, especially from the electronics industry. So I personally think this chart is confirmation of what we already know, that there's a supply shortage, and that shortage is going to get bigger. The big market here that you see, the biggest single asset that you see on that list is gold, which has got a 23 trillion market cap. But as we come down the scale, we get to Nvidia at 4 trillion or over 4 trillion. And you're going to tell us a little bit about Microsoft as well, Mario, I think. And then you get down to silver, which is half the value of one stock. It's half the value of Nvidia, or if you like, half the value of Microsoft and probably one or two others. So the silver market, the point I'm making here is the silver market is only 1/10 of the size of the gold market and less than half the size of the two biggest stocks on Wall Street, at least. It's a very small market. So if we have some sort of loss of confidence in the let's say the Nasdaq or the Mag 7 or the top stocks, where's that money going to go? You only need a very small amount of it to go into the silver market. It will push the silver price a very long way. That's my point. Silver is a tiny market compared with gold. But if you look down a little bit further to platinum, that's silver's 1/10 of gold, but platinum is nearly 1/10 of silver.
Yeah.
So it's like not nearly getting on for 1/100th of the amount of gold. So even a tiny bit of money moving into silver or platinum will push the price a long way. And I have discussed with you the trigger for what might move gold up. So if gold goes up sharply, and there is a reason to think it will, if gold goes up sharply, there will be sellers of gold and piling into silver, but that will have a much more leveraged effect on the silver price than it does on the gold price. Because if you take $1 trillion out of gold, it hardly moves the market. But if you put $1 trillion into silver, it pushes you've got this hugely leveraged effect because silver's only a 2 trillion market. And I have written that article the other day about what will happen if Scott Bessent does go through with his plan or his words to monetize the asset side of the Treasury's balance sheet, of which the most undervalued asset is gold, and the biggest asset is gold, and the most liquid asset is gold. That's the one thing they can monetize and make a ton of money very, very quickly, paying off the current year deficit, paying off next year's deficit, and of course, reducing their national debt. Now, we don't know if he's going to do it. We don't know, and if it is done, we don't know when it's going to be done. But if it is done, it's likely to be done at a much higher gold price, engineered gold price, than the current price, which would that would have the very leveraged effect on silver. That's my point. All my career, I've been hearing people point to assets which have just risen in price, and it doesn't matter whether it's a week after or a year after. Maybe they're going up for 5 years or 10 years or 20 years. They'll point to the asset and say, it's too high, it's going to crash. Well, what I've come to learn is when people say this, they're trying to justify why they didn't buy any at the lower price. People have got to get this out of their head that yesterday's price was the right price. I mean, but the world is full of people who are looking for patterns in the price. They see a price pattern and they always think that, I mean, this is not everybody, by the way, it's not me, but there are people out there who always think that last week's price or last month's price or last year's price was the correct price. And because the price is different today, it's got to go back to the old price. And then they try to justify the fact they didn't buy that asset when it was a much lower price by saying it's overpriced now, the old price was the correct price. But I think not. I mean, look at the increase we've seen in government debt and the money supply over the decades. It's literally ballooned through the roof. And that's what's driving the price of these limited supply assets like gold. There's a very good chart pattern, which only really applies if you could use it in conjunction with knowing other things, and that's called the flagpole, a bit like the corner flag on a football field with a little triangular flag. So when you see the price rising, and then it pauses and it comes back a bit and then goes up and down in a sort of zigzag pattern, but moving towards a triangle at the end.
Like this one, yeah, the weekly one.
Exactly. There I see a very nice flagpole pattern. Now, provided you have other information, which we do have, and we've talked about that, you can that in general is a very, very bullish signal, because when it breaks out of that triangle pattern, it moves a long way and in the direction of the flagpole. So in general, it should go up, but as I say, you've got to have other information, which we already do have because we've discussed it many times. But you've drawn the flag there, and you see the pole on the left-hand side of it. So it could take a few months before it breaks out, but when it breaks, it's going to go a long way. The weaponization of the dollar does mean that there's now a real worry that from countries all around the world that they need a plan B. And to have a plan B, you've got to have something which actually works. So an alternative to the dollar is something which everybody's working towards and it's not, I think it's not just the BRICS, but obviously it is led by the BRICS. So I think it's only a question of time before we see some sort of alternative currency system starting to emerge. It will take some years. It's not like it's going to come out tomorrow. And by the time it does emerge, Trump will be long gone anyway, because he's only got a 4-year term. So, but I think it's coming. And I think down the line, the BRICS countries will have an alternative payment methodology, and they won't have to use the dollar. They'll probably be using some alternative system, which I think will include gold. I think it will have to include gold, albeit that the gold won't be moving, but a currency, perhaps a new currency, will be moving, which is convertible to gold.
Gold and silver just took a hit. Silver got clipped harder, but both metals are coming off sharp corrections. If you're only watching short-term charts, it looks like trouble, but zoom out and a very different picture emerges. MarioInnecco says exactly that. Don't get distracted by the daily noise. When you pull back to the monthly charts, silver is still up 26.35% year to date. That's not weakness. That's strength taking a breather. Gold is facing similar pressure, hovering around $3,290 and on track for its worst weekly close since late June. What's dragging it down right now? One thing, the dollar. It's been flexing again, this time fueled by aggressive trade policies coming out of the US President Trump's global-based tariff, a flat 10% on all imports, combined with retaliatory duties up to 41% on non-trade agreement countries, is driving dollar demand. That demand suppresses gold in the short term, but here's the catch. The fundamentals haven't changed. China is buying gold, a lot of it. Officially, the People's Bank of China added 2 tons in June. That's the 8th straight month of reported increases. Year to date, 19 tons purchased. Gold's share of China's forex reserves jumped from 5.5% to 6.7% in just 6 months. But MarioInnecco points to something far more interesting. China may be underreporting its true reserves. He believes they could be holding 30,000 to 35,000 tons, a number that dwarfs the official tally. Why underreport? Simple. If they revealed the real figure, gold prices would explode, and that would slash the purchasing power of their remaining dollar reserves. Let's get back to the interview.
In the last few days, gold and silver have corrected quite sharply, especially silver, and people are worried. But looking here, and I'm going to bring up this chart, and then we're also going to look at market caps, but bringing up this monthly chart of silver. So we're already in the month of August now, but in the month of July, we closed at 36.72 or thereabouts. So it's the highest closing level since August 2011. So silver actually closed, at all, like almost a 15-year high. And I think that's positive. Yes, it's come off from the highs, as we can see here. And this candlestick looks a bit weird. I don't know if it's bullish or bearish. And here's a chart of gold. I've seen videos now. People have sent me videos. I'm not going to mention names of people saying, "Oh, be careful, gold could crash." But anything's possible. But I personally think we're just in a consolidation here. If you look at the weekly chart. It's pretty much what happened here and what happened here. It takes a little while. I think the reason it's taking longer now, it's because this move here from the beginning of the year was very strong compared to these previous 2 moves. So it will take a little longer to take out all the speculative and longs and stuff. These indicators like the debt and money supply, we've seen M2 money supply, not just in the US, but in Canada, China. It's making new all-time highs, and they're not going to stop the wheel moving, the hamster wheel. I saw President Trump posted something recently, and he said, too late, Powell needs to cut. The economy is doing well, but we need people to be able to borrow, to buy their homes, and to refinance. So it seems to me that the Trump administration and other administrations around the world, what they worry is about is when people stop borrowing, because that could implode the whole financialized economy, and that would mean really cut all the tax revenues. It would put governments in real trouble. So here's the monthly chart, Clive. It looks quite weird. The last 3 months, no, 2 months or 3 months, we kind of settled pretty much at the same level, and we've had a little bit of a range in between. We hear a lot like how the US economy is doing really great. It's the hottest economy. It's oh, because I wanted to talk about because you're talking about the FOMC meeting, and yeah, I agree. If anything, I think if Greenspan was the chairman of the Federal Reserve and he saw what gold's doing, what the stock market is doing, he probably would be raising rates or definitely not cutting. But today we have a really important number, which is the non-farm payroll, which comes out most of the time the first Friday of the month. And I saw that the expectation is quite low, only like 100,000 new jobs. I think the US economy needs like over 200,000 to keep with the demographics. Even though this statistic is all a survey, it's not like real numbers. And I could see a very weak number. And why is that? Well, because the US government controls the BLS. And I think if we start seeing weak jobs numbers, maybe that will be what pushes the Fed to cut rates. I don't know, am I being a little bit too conspiratorial? I wanted to touch upon BRICS because a week or two ago, Trump said that BRICS were irrelevant. They had a meeting, no one showed up. But now it looks like indirectly he's like declared war on BRICS. He's not happy. He says BRICS are anti-dollar, anti-American, and I think that's wrong. I think BRICS just want more. They want more multilateralism. They don't want a unipolar world, and they want to be heard. But be as it may, he's imposed some tariffs like on India, Brazil, and he could impose secondary tariffs on China for buying oil from Russia. And it seems like those countries in BRICS are being targeted, not because of the trade situation, but political situation. So it definitely seems to me that he's concerned. And I listened to a guy called Alex Christoforou. He does the Duran. He's a really good geopolitical analyst, and he said that it looks like the trade tariffs are the new sanctions. So just wanted your view on that, whether this attack on BRICS could backfire on Trump, because they could come back and say, well, we're going to stop using the dollar even more. We're going to offload a lot of our treasuries. So why would the U.S. Treasury be taking delivery of gold? Well, maybe because they will have to do an audit, and a lot of the gold that they had there has been leased out. And when you lease gold, you have to ship gold to the people that you lease the gold to. And you can't have an audit if the gold isn't there, and you can't really do a credible revaluation of the statutory price if the gold isn't there. So, or it could be Berkshire Hathaway, Clive. I saw as well that their, and I'll bring it up here, that their cash positions are, Berkshire Hathaway's cash position is now 30% of their total assets. So they're concerned about something. There is speculation that they have like 30 or 35,000, but maybe they want to keep it like this because they want to keep buying. If they came out and said they've got 30,000, the price of gold would go through the roof. Their dollar reserves would plummet in terms of real value, I think. So yeah, it's a good point that they will probably continue to buy quite a bit and to match the US. And we don't even know if the US has, and the US is the other speculation, whether they have it or not. And one thing that's concerning is the little UK here. We only got 310 tons. I mean, we have less than Portugal, Taiwan, Poland, Turkey. I know Gordon Brown sold half of it, but even if he hadn't sold half of it, we still wouldn't have that much. And it's interesting that Germany and Italy, they have quite a bit, and France. I guess that's why they are in close negotiations. Like this Liberation Day starts today, but with China, they've given China till the 12th of August. And a lot of people say, Clive, that these trade negotiations is just not a cover, but it's not the real. It's just the tip of the iceberg, and that a lot of the negotiations are going on in terms of the reserves and the price of gold, because ultimately gold is the what values assets. So you could be right about that. They could have some kind of shock for the Chinese.
The World Gold Council's Q2 2025 Gold Demand Trends Report reveals that total quarterly gold demand reached 1,249 tons, a 3% increase year over year amid a high-price environment. Substantial gold investment flows largely fueled quarterly growth as an increasingly unpredictable geopolitical environment and price momentum sustained demand. Price alone rarely tells the whole story, and right now, gold and silver are a perfect example of that. Short-term drops have spooked some traders, but the deeper forces shaping these markets haven't let up. Investment demand is climbing, supply chains remain tight, policy shocks are distorting currency values, and across Asia, metal reserves are rising fast, often under the radar. What's unfolding isn't just another cycle, it's a structural shift. If official reserves don't match actual accumulation, and if supply deficits are patched with recycled scrap, how long before the disconnect breaks the system wide open? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.